Hi, I'm Matt Armstrong, a financial advisor at Savant Capital Management. I'm here to welcome you to Savant Backstage, a video series that will give you a behind-the-scenes look at what we do. Our goal with this series is to help you build your ideal future by providing you the tools and information you need to become a better investor. Today's topic consists of a series of videos that describe our 5 diversification strategies. We covered these briefly in our Building Better Portfolios introduction. But now we'll take a more detailed look at the reasoning behind each piece of the portfolio. And now your host, Gina Beal.
Hello, I'm Gina Beal, and I'm a member of Savant's Investment Committee and Research Team. I hope you have already listened to the high-level video of how we build better portfolios at Savant and are back for more detail. This segment is focused on the 4th of 5 strategies we employ in portfolio construction, in which we tilt toward value stocks. The next few minutes will be focused on the rationale for value over growth stocks. As their name suggests, value stocks are generally thought of to be a bargain or on sale. The price is low relative to company assets, sales, and earnings potential. Value stocks often tend to be older companies that, for one reason or another, have fallen out of favor with the financial media. They no longer generate buzz. On the other hand, growth stocks, sometimes called glamour stocks, are splashed across the headlines of magazines and newspapers. Typically, these have had very good runs and thus attract a lot of attention and are good cocktail party topics. Naturally, there are plenty of investors willing to buy them. The catch, however, is that high expectations generated by heavy media coverage often causes growth stocks to be overpriced. So next we're going to look at the data. This chart illustrates that history has rewarded the value investor over the growth investor. The margins are sizable across the board. The blue bars show that since 1928, value stocks have outperformed growth stocks in the U.S. large and small cap categories, with U.S. large value stocks beating large growth stocks by 2.2% per year on average, and U.S. small value stocks beat small growth by 4.8%. While the international data does not go back as far, a value premium also holds true in the developed, international, and emerging markets. Looking at this data, it can be tempting to consider investing exclusively in value, but the evidence warns against too much concentration in one area of the market, which is why Savant only tilts toward value and still has growth stocks in the portfolio. Let's take a look. Here we show year-by-year return differentials back to 1973 for value versus growth stocks, which we use to show which one was the winner each year. You can easily see that there are some periods of time, such as the late 1990s, when growth stocks outperformed value stocks by a wide margin, and at times for multi-year periods. So while value stocks are preferable over the long run, we don't want to completely avoid growth stocks. An asset mix that includes both value and growth provides the diversification necessary to reduce risk. Of course, investing in value stocks does not require the selection of individual stocks any more than investing in small stocks. Therefore, Savant aims to capture the value stock premium using funds that represent the broadest exposure possible to the market segment. That concludes our discussion of the strategy of tilting toward value stocks. Thanks for watching this segment. Please be sure to check back in for the next segment in the series. If you have questions or would like more details on this topic, please contact us by emailing your questions to info@savantcapital.com or by visiting our website at www.savantcapital.com/EBI, where you can download a copy of our evidence-based investing white paper. You can also call us at 866-489-0500 to request a free copy of that white paper.